Welcome to our latest video blog in our new offices, which we've just moved into at the start of this week. First of all, before we do our normal review of markets and how we see the future, we wanted to announce that we've just launched a new larger cap UCITS fund, the SWMC European Fund, and this is going to be run on a very similar basis to our other long-only accounts, but we will have the full flexibility to have raised cash and to run a number of short positions as well. And we're delighted to have launched that at the start of November. Turning now to markets, we still have a reasonably positive view overall, and I think we've been encouraged that how resilient markets have been in the face of all the turmoil that we've seen in the Eurozone. I mean, looking at the negatives first, of course the biggest challenge to all of us is what's happening to bond yields in Italy and Spain. Our view is we believe there'll be a muddle through, and particularly with the discussions that happened over the weekend, the first stage of the process of resolving the problem has been put in place, namely closer fiscal integration, and we think at some stage this will be followed by further help from the ECB and possibly even quantitative easing. So we think there'll be a muddle through to the European crisis. I think particularly based in the UK, many of us forget the political will at the core of Europe to make this thing work. Moving to the positives, which were on slightly easier ground here, I think the first thing is to say is that the corporate sector is as strong as it's been in the many years I've done this job. And in fact, the 400 companies we've spoken to since the crisis broke, again the most recent phase of the crisis broke in July, all have reported that business remains strong and very few have seen any downturn in activity. The only slight areas of weakness we've spotted have been in Italy and Spain, where consumer has been a little bit weaker than we expected. I think the second thing is financially and structurally, companies are in extremely good shape. Operating margins this year will reach 12.6%, which is even higher than the level they achieved back in 2007 at 12.1%. And maybe even more importantly, net debt to equity has now fallen below 30% this year, and that will be the lowest number for the last 3 decades. So the companies we're looking at are stronger than they ever have been, certainly since in the 20 odd years in which I've done this job. And finally, valuations are extremely compelling. We're now down to 7 times earnings for the European market, and this is the lowest level we've seen for the last 4 decades, and we're getting somewhere near to valuations we've seen in the 1930s. So overall, looking purely from the company perspective, markets look terrific value. We've clearly got all the anxiety around the Eurozone. We think there is a greater chance than not that we have some sort of a muddle through, and we appear to be, with what happened last weekend, moving towards resolution, further fiscal integration, and we would hope at some stage greater help from the ECB. As to the shape of our funds, very similar to how it's been in the past few months. Above all, a focus on best quality. In the industrial area, we still have our favourite holdings such as Legrand, Assa Abloy, Essilor, and Air Liquide. On the consumer side, we still favour the luxury goods businesses like Louis Vuitton. We also have holdings in companies such as Hennes & Mauritz and Seb Group. Outside this area, we have 1 or 2 investments in the utility area, principally Eurotunnel and Atlantia, and we still have only a marginal exposure to financial companies, where we believe the risks and uncertainty remain very high, although we are starting to be intrigued by some of the better quality ones, where the valuations have fallen to such a level that they might be starting to look interesting. Thank you again for listening, and we wish you all a very happy Christmas and a great New Year.